Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for WealthPress. Today's Thursday. It's January 27th. It is almost the end of the month, and don't ask me where the month has gone. It's about 7:52. The market's going to open up in about an hour and 38 minutes to be exact. We've got some news before the opening bell, and I'll get into that in a minute. But as you can see here, the NASDAQ 100 is up a bit. The Dow futures are down 88. It looks like a very random market, especially with everything being disjointed and in light of all the trading action we've seen to the downside the last few sessions. Now, what's interesting today is, as you can see here, the bond market has been going down quite a bit. The Fed talked yesterday, and we'll get into that in a second too. I wish I didn't have to, but I will. But as you can see here, the bond market's up quite a bit from yesterday's close, which is actually a sign that interest rates have had enough. Because remember, there's an inverse relationship between long-term bonds and interest rates. So it looks like we could be bottoming out. And I've been waiting for a bottom out for a while because this is too much too fast. I mean, this is, we were at 155. We went all the way to 140. That's a 10% drop in the bonds in, let's see here, in less than 2 months, in 6 weeks. So it's a little too much too fast, and I am expecting the bond market to go higher. Yesterday's low was not as low as the previous day. So it appears, and momentum levels are pretty good here. It appears like we may be going a little bit higher on the bond market. And if we go on the bond market, that relieves pressure and allows the stock market to go a little higher. Because think about this. Why is the stock market going down? Why is it under so much pressure? Because of bonds, because of interest rates, because interest rates are going to go higher. Well, in this case, interest rates are actually lower. So the actual bond market itself is telling us that we're a little bit overdone in the long term. This is the long bond. So I'm just kind of equating everything to everything. And lately, bond market has been going down, and so has the stock market, especially the consumer discretionary and technology. So keep your eye on the bond market, especially in light of the GDP report that's happening today. Now, again, before I get into the Fed data, we had international trades in goods and services yesterday, and the number came out nasty. The expectations was a deficit of 95 billion. We had over 101 billion. That's a problem. That is a problem. New home sales were good. And then we already know what happened with the FOMC, and we'll get into that in a minute. But today, in about 36 minutes, we have durable goods and GDP. Now, the GDP, let me give you the expectation. And this is going to be a very interesting and a very big market-moving report. We're all over the place, everywhere from 3.7 to 7.1, but this is the expectation. If the number is substantially lower than this, it can actually cause the market to rally, because then it would imply that the economy is not growing as fast as the Fed is saying it is. And if that's the case, well, what are they going to do? They're going to keep bond market suppressed or keep the bond market inflated till the economy gets up to speed. But if the number is near 5.7 or 5.8, it may actually be bearish for the market, because then it would prove that the Fed has a point in saying, hey, we're kind of going a little too far too fast, and we need to slow down because the economy is heating up too fast. And then we have personal consumption, which is expected at 3. Now, this is coming out before the market opened, and again, the expectation is 5.7 and 3.0, and this report takes into account 2/3 retail sales for the quarter. We had a little slight preview of retail sales, and the number was solid on Redbook. Whether it'll reflect in the GDP today, that's a whole different story. We also have jobless claims. The number has been ticking a little bit higher, but honestly, in light of the COVID situation, it's not that bad. We went like from 200,000 to 270, 260. Not as concerned with this number as I am with the GDP, especially in light of the FOMC meeting yesterday. Let's talk a little bit about that meeting yesterday. And this is important, and the language the Fed chose. Oy, oy, oy. Global stock market and Wall Street sank Thursday after the Fed indicated it will raise rates soon to cool inflation. Again, we'll see how hard that inflation is at the GDP today. Market benchmark in Tokyo, Seoul, fell by an unusually wide margin of more than 3% following what happened on Wall Street yesterday. The Fed said Wednesday it expects it will soon be appropriate to raise rates. They didn't say soon we will raise rates. expect it will soon be appropriate to raise rates. Okay, investors expect as many as 4 increases this year. Don't think it's going to happen. Starting in March, don't think that's going to happen. Or maybe, I'm expecting maybe 2. Bond purchases, monthly bond purchases that push down long-term rates by injecting money into the financial system would be phased out in March. We'll see if that happens. And the GDP may be a very, very, very instrumental in that data. On Wednesday, major indices rose immediately after the Fed statement, but gave up their gains as Chair Powell took questions about how and when the central banks will let its balance sheet shrink after buying trillions of dollars of bonds through the pandemic. That would put pressure on the stock market. The selling accelerated as Powell acknowledged high inflation that has squeezed businesses and consumers isn't getting better. That could force the Fed to get even more aggressive, but I don't think they're going to do that because they really are very protective of the stock market. The last time the Fed raised rates, its balance sheet at the same time was late 2018, and the S&P lost nearly 20%, but has recovered quite a bit. And I believe the stock market has lost, about 10%? We'll take a look at that in a minute. Powell said that there's room to raise rates without hurting the labor market, and it wouldn't rule out the possibility that the Fed could raise short-term rates at any of its 7 remaining meetings this year or opt for a larger than usual increase at any one of them. He's playing, he's learning from his predecessors. He's becoming ambiguous. Looking at the stock market as a whole, looking at the Dow, let's just see here. Dow is down only 70 points, 74 points pre-open, so it's a little bit beyond random. And if you look here, we went from 370 to 340 to 330, right? That's about 10% right there. Do we have another 10% in it? I don't think so because of what's been going on with the market. And the market's very different right now than it was in 2018. Fed wasn't injecting gazillions of dollars of bonds. I still think we bottomed out here. In the Dow, we need to watch this level, this 330 level carefully. The key is we're still making higher highs. So if this bar reaches higher and hits the 200-day moving average, we're going to be in better shape. Keep an eye on that. Looking at the SPY, the SPY's down. It's actually up a little bit today. Again, we perched and violated the 200-day moving average to the upside, which is actually a very bullish sign. We didn't stay there, but if this bar right here, this bar we're at right now, if this takes out the high of yesterday, we're in better shape again. So don't look at where we closed yesterday. Look at the highs. The highs are getting higher. Very, very important. Today, I want to see us break above 444.64. And on the QQQ, let's take a look at that. And the QQQ, by the way, has peaked out at 409 and went down to 340. Last time I checked, that's about a 408 to 340. That's about a 15% dump right there. Again, keep your eye on the highs. I want to see if we can break out the highs, and hopefully we won't break the lows. The high level is 356. Also, this is something we haven't looked at in a while. This is the Semiconductor Index, which is one of the biggest indexes under pressure. And as you can see here, it's also reaching oversold territory, and it's making higher highs as well. This thing peaked out at 319. We're at 259. It looks like we lost already close to 15%. So the point I'm saying is, I think the worst is almost behind us. Volatility looks like it's curving. It doesn't look like it's spiking yesterday. It looks like it peaked out yesterday. This is over a 3-month period. Right here. It looks like it peaked out near 40. It didn't look like it went higher yesterday. And if it starts breaking down, it's a very, very positive sign. Also, percentage of stocks. This is not the Nasdaq. This is percentage of stocks trading above the 50-day moving average of any stock trading above $2. Look at where we're at right now. This is COVID right here, right? And this is that 2018 shakeout where the market lost 20%. We're very close to there right now. And as you can see here in the last 20 years, we violated the current level once, twice, barely, 3 times, 4 times, 5 times, 6 times. So it's not something that happens often, and I believe the market is actually going to bounce back. I think the bond market is going to trade a little higher, and I think we're going to see higher highs from bonds and from the stock market. Everything looks really, really oversold, including the consumer discretionary sector, which peaked out, by the way, at 215, is now at 178. So I think, and it also made a higher high. It looks to me like markets are starting to turn around a little bit. Also, I want to show you something interesting here. If you look at market momentum, If you look at market performance, and if you look at the NASDAQ 100, only 14% or 14 stocks out of 100 are trading above the 50-day moving average. Folks, this is a 6-month chart. Look at a 20-year chart. Let me just make this palatable. Look at that. We're there, folks. We really are there. So I'm being very, very patient, and I'm being very slow to initiate new positions right now, and we're being very defensive. But earnings are getting better. Fed data is not that bad. I think the Fed is not going to raise rates 4 times, which is what the market is pricing in right now this year. And I think if we're a little bit patient, we can get out of this in a good way. If you look at the heat map, I want to show you this yesterday. Look at the 1 day. Semiconductors. This is yesterday. Semiconductors already started gaining back up. Hotel stocks were gaining back up yesterday. So we're still very, very defensive. But when you look at the heat map, there are some consumer discretionary stocks moving higher. On a 5-day basis, hotels are starting to come up here. This is very important because COVID is starting to die down. Business information is starting to come up here. Gaming is starting to come up here. So again, I think the worst is possibly behind us. And in light of that, I want to show you something. I want to give you a good sector to look at today. Now, we've been really, really focused on the energies, but I want to show you guys something here. The consumer staple is really starting to gain behind the energy sector. And if the stock market bounced, the consumer staples and the financials are going to bounce really good. Now, if you look at the consumer staples right now, look at them on a shorter term basis, you will see that they're barely on the 50-day moving average. They're actually holding up a lot better than the stock market. And I think right now, especially in light of where we're at, it's a really good time to get into consumer staples. We actually have this in one of our services, but you would be getting at a better price now because we got in right here and this is right here now. But we got a long-term option. I love this sector. And today's Thursday, and I'm going to give you my top ETF, which is consumer staples right now. And if you're looking at options, I would go far. I wouldn't go close because God only knows what's going to happen in the near term. But I would go all the way to the middle of the year. We have 141 days left. And I would be looking right now at the 74, 75. This thing is trading at like $3, $2.60. Look at the open interest and volume. In my opinion, this is a no-brainer right now because I think in the next 6 months, the stock market is going to be substantially higher. So XLP ticker symbol going all the way to January, February, March, April, May, June, and we're going to the 74 or 75 strike price. And if you want to really save money, buy the 74 and sell the 77. You can get still or the 78. Yeah, you can get the 78. 74 against the 78 or 74 against the 79. Those two seem pretty kosher. Now, before I let you go, before I let you get on with your day, I want to tell you a few things. First of all, don't panic. This happens every few years. Typically 15, 20% correction and the market pulls back. Well, I got news for you. We peaked out about 16, 15% ago, so we're almost there. And the momentum levels are saying the same. We're not going to be in a bear market. If the Fed put too much behind this market to roil this right now. And as we've seen, they're very vested in the stock market. A little more vested than they should be, if you know what I'm talking about, with all their trading action. So I think the Fed is going to cool off, and I think they're trying to make up now for the toughness that they should have exhibited 6 months ago. And I think it's kind of like the boy who cried wolf, but I think it's an overreaction right now. It's too much too fast at one time. Also, earnings are getting better, and I'll talk about earnings in my next video. Don't miss out on that. But before I let you go, I've got something hot for you. Folks, if you want to know who's been doing really, really good during this whole thing, it's Jeff Zananeri. Joy of the Trades, Jeff Zananeri. He's putting together a masterclass workshop to teach everyone about fade trading. Folks, Jeff and I were talking about this in my office yesterday. You should have seen me. I was so excited when he showed me this strategy. It's It's like day trading without day trading. I love this because why do people hate day trading? Because they're getting in and out in the same day. This avoids that, but gives you that same benefit. So it's like day trading without day trading. This fade trade, you're going to love. It's a strategy he uses on a daily basis. There's plenty of opportunities left for these sort of trades. Wall Street often needs to recoup cash quickly. And how do the big hedge funds do it? By selling off assets for a quick turnaround at the end of the day. Wait till he teaches you this. Now, we can hop into these stocks at a great discount. And when the price recovers the next morning, we unload them. It's like in at the end of the day, out the next day. In at the end of the day, out the next day. So you're taking advantage of one night overnight. But that's it. One night overnight. It's awesome. I love this. And it's been working great right now. You want to click on the link below and learn more about these fade trades and sign up for a workshop at 1 p.m. Eastern time today. 1 p.m. Eastern time today. I'll be there. I'll say hello to you guys. You don't want to miss out on this. It's going to be very, very cool. Again, Jeff fades trades end of the day and gets them in the morning the next day. I love this strategy. Like for volatility, it's probably one of my top 3 strategies. I love this strategies. I may start taking some of these trades because they're so cool and they work so well in this very, very choppy market. So it's a great way to buy at the end of the day or sell at the end of the day and get out of your trade the next morning. You gotta check this out. His track record speaks for itself, and Jeff's been doing this for over 20 years. Folks, click on the link below. Check out this fade trading business. Sign up. It's happening at 1 p.m. Eastern time today. I'll post the link below this video. And tomorrow, we're going to have a full-on recap, talk about the biggest opportunities, biggest downside, winners, losers, what to expect the following week, complete with levels. Don't miss out. Talk to you tomorrow. Send me some feedback. Bye, guys.